Welcome to the Voice of Retail. I'm your host, Michael LeBlanc. This podcast is brought to you in conjunction with Retail Council of Canada. Retail real estate has been fundamentally shaken up by the pandemic. Between lockdowns for non-essential services and accelerated e-commerce growth, investigating the health of retail through the lens of real estate market offers us a wealth of information. This special episode of the Voice of Retail features an interview picked up from my weekly live stream that I co-host with Retail Council of Canada the last week of June. Get an in-depth analysis of the current and future state of the Canadian retail marketplace from the expert perspective of Cushman & Wakefield's Executive Managing Director of Retail Services, John Crombie. In this interview, my co-host for the evening, Carl Littler, RCC Senior Vice President of Public Affairs, and I call on John's professional experience and research to unlock new information about the retail marketplace. From malls to warehouses, we discuss the need for technological innovation, changing real estate prices, and new opportunities to keep up with the evolving consumer behavior.
Retailers, when they've been culling out underperforming stores, have unfortunately probably been in some of those particular secondary malls. You mentioned a flight to quality. Yes, people are saying I'd rather have less locations, but I want to be in the best malls.
Let's listen in now. John, welcome. Thank you for joining us.
Thank you very much, Michael, for having me at this today.
Yeah, it's great to see. We've been talking about, and the members have been asking about, could we get some experts on around real estate? And we thought, what better expert than yourself? So last time you and I were together, we were at your offices in the before time, and we were talking about, the retail apocalypse as a media narrative, that it wasn't real, but the transformation was certainly real. And we were talking about, what the trends and the implications were for landlords and for real estate, both on the front facing and also, of course, on the commercial side. But man, after the past 18, 24 months, I'm really interested to hear your perspectives and your organization's perspectives.
So first of all, I'm John Crombie, as mentioned. I'm Executive Managing Director of Retail Services for Canada. Been in the business for almost 30 years, half of that in the retail side of things. I manage the retail brokerage arm across Canada. I also thought I'd just quickly talk about Cushman & Wakefield. Many of you may not know about Cushman & Wakefield. Then I'm going to get into some stats we're currently seeing in the marketplace and just give you a sort of sets the stage of our conversation. And then some observations and predictions and some things you probably heard about. But I agree. I think we talked about pre-COVID, but COVID has really been the great accelerator for a lot of these changes, and many of them actually quite good for the industry overall. Yes, we've had some bumps along the way, but COVID has really just enhanced what was happening in the industry. First off, about Cushman & Wakefield, 50,000 people around the world. We did $7.8 billion last year, a little bit less than 2019 for obvious reasons, and we're in 60 countries. We have a lot of services, but to simplify it, we're in two major areas. We're occupier services and investor services. So occupier services, we do tenant representation work for office leasing, industrial sales and leasing, and retail sales and leasing. We do FM work for clients across the country and internationally. We have a group called the Global Occupier Services Group. We work with a lot of the Fortune 500 companies as being their real estate arm. On the investor sides, we have agency leasing, which is, again, representing the landlord on property listings, again, in all categories. Capital markets is our investment arm, selling properties, including shopping centers. And we do project management and development work as well for a lot of the owners. We have valuation advisory and consulting services. So there's many facets of it. As it relates to retail, we are in America, we're global, but in Americas, we're servicing about 95 markets. 1,100 professionals. We did about 10,700 transactions last year. And those may or may not know, but 4 years ago, we bought a company called 20 Vic, and Cushman now owns it, rebranded to Cushman & Wakefield Asset Services, which is our property management arm. And for retail, we manage about 16 million square feet across the country on some Pickering Town Center would be a great example of one of our properties that we manage on behalf of third parties, mainly pension funds. But we also do office and industrial. Enough about that. So let's talk about the Canadian retail market and what's happening. This slide I just got actually a few hours ago, the Canadian household spend. And we're definitely seeing it heating up as restrictions are easing. And when you look at 21 compared to 20 and 2019, we're actually 14% above a year ago and 11% ahead of 2019. So it's all good. We've actually seen huge uptick spending in the clothing category, as well as food and accommodation. So looks like Canadians are reaching back in their wallets and making some spends, which is great, obviously, for the retail industry. When you look at retail sales by province and by city, it's kind of a different story. And in fact, retail, when I talk to my broker group out there, I mean, it's very active market right now. And you can see as of March, year-over-year sales are up over 12%. And Montreal, which has now bounced back, we're actually seeing an uptick of over almost 7%. But unfortunately, Toronto, which I think all of us can know this, but I think it's been probably the most restricted and locked down market probably in all of North America. And it's unfortunately seen a negative sales, total Canadian retail sales of down 4.77%. The good news is that the prediction for retail sales for year-end 2021 would be upwards to 6% overall. So we are expecting a good bounce back. Last year, year-end 2020 was negative 1.7% in retail sales. And that was the first time we had negative year-over-year retail sale declines since 2009. So it's been a pretty good run regardless. Another thing to bring up is store counts. And we saw for Canada for 2020. Last year was a record. We recorded 2,026 store closures, which was up about 3.2 times more than 2019. Some of the categories or some of the retailers that saw, in fact, Starbucks was the largest giver up of locations, 300. And most of those urban versus suburban, and I'll get to that in a minute, followed by David's Tea. But you can see the traditional, especially clothing retailers, Le Chateau, Comark, Le Deschanel, have given up not a lot of locations. Upwards to 5.5 million square feet has come back to the marketplace. When BDO did a recent study in for 2021, and they expected that 44% of retailers will be seeing declines this year. So we're not out of the woods yet. There's still some retailers that have obviously done very well because of the pandemic, but there's many that still need to work through some of the challenges they faced. And when we looked at rent issues, I pulled this out. This is actually RioCan from their investment call in May of 2021. And I like RioCan that I think they're a good bellwether for all of Canada. They're their largest shopping center owner. They own multiple categories of retail, enclosed shopping centers, open air, and so on. And they looked at what they called their strong and stable tenants, collected 98% of rent during that period, but they still deemed about 1 out of 5 retailers that are vulnerable. And some of them prior to the pandemic were still there. So it's kind of playing into sort of what we expect for retailers that we're still not out of the woods going forward for 2021. When we look at Canadian retail rate growth for retail, this is asking rates put out by CoStar, just came out about a week or two ago, and they looked at where we are to date. So you can see in 2021, we're seeing a decline in asking rates for that. So it's an opportune time if you are able to look for new locations, is that we're certainly seeing a decline for this year, which was falling out obviously from last year's pandemic. But in 22 and 23, they're expecting actually quite a big bounce back as it relates to asking rents. When you look at declines in rental commercial rents for retail by city, this is year over year. So looking at December 19 to December 20, you can see each city how we've seen some declines. For Montreal, a negative 4% decline year over year as of December. Toronto hitting a decline of net effective rental rates of 11.7%. Calgary, which it's not a pandemic story, it's a resource story, down about almost 22%. And Vancouver is staying really strong. I mean, down only 2.3%. But I suspect in the next quarter, which I'm just waiting for those numbers, that's probably gone up. And we're seeing actually positive rates increases in rental. Now look at some of the predictions and observations. One of the most interesting one that we've seen both in the United States and Canada is the tenant mix is shifting to more temporary retailers. And in fact, this is from enclosed malls, but you can see that it's now, although the occupancy level has gone down in this particular study down to 90%, almost 8% of the retailers are now accounted for as being temp retailers. Usually that's under 3 years. Most of the time it's under 1 year. So landlords have responded by putting temporary tenants in there, filling up some of those vacancies. And of course, we've seen that in Canada. As mentioned, we had 2,000 vacancies. And so you need to put somebody in there. So we're looking at temporary tenants, which is an opportunity if to get into malls that you traditionally haven't gone into in the past. We're also seeing a lot of those temporary tenants are more local focused rather than nationals. And you can see that has changed from 2018 of only about 4.5%. So certainly a big shift as it relates to the temporary tenants. Retailer strategies, again, a BDO report suggesting that there's certainly a lot of restructuring happening, but we're definitely going to see an uptick in M&A activity. We're seeing it already. A lot of the fact that retailers are looking at opportunities, low interest rates, bringing different technologies. And so expect to see a lot of that activity in the retail market going forward for 21 and 22. Geographic expansions, it's going to be more about the quality of locations, not the quantity of locations. As retailers, you're not a retailer, jokingly, if you're not expanding. And so we've seen some huge growth, both in the United States and Canada over the last couple of years. But people be focused more about about the quality of locations. So we expect to see, quality locations being well sought after rather than retailers going out and just trying to blanket as many sites as they can get their hands on. A lot of it has to do with the fact that capital reserves have been drained to get through the pandemic. So we don't have quite the resources that we've had in the past. Third is the prediction is retailers have sharpened their last mile strategy, and we're seeing this time and time. The whole idea of BOPIS, buy online, pick up in store, and curbside pickup has increased by almost 100% across the board. Consumers are getting used to it. Retailers are getting used to it. We're actually seeing buying online, picking up in centers where landlords are accommodating for all retailers, not just the major retailers who certainly are able to do the BOPIS. And new fulfillment, definitely smart centers and micro fulfillment centers are becoming more and more common into how to deal with that last mile delivery, which is a very expensive component of that. But e-commerce isn't going away, and retailers, they need to do these things to make sure that they can touch their customers in multiple ways. And I think you'll even see these autonomous vehicles probably marching around the downtown or other areas more frequently than ever before. And the pandemic has really heightened our focus on local retail. And as I mentioned in the temporary spaces, local is filling up a lot of those voids. And I think as consumers, we're spending obviously more time at home. The importance of our local retail has never been heightened more so. And the good news is that when you spend $100 in your local retailers, according to a study here, is that $63 of that is recirculated into the local economy. And that's good. And this is from the Super Bowl where Uber Eats has really been promoting shop local. And I think you'll see that as a sort of opportunity going forward and something that's coming a fallout of the pandemic. And when we look at dining and we all get back to our favorite restaurants, the predictions is that we'll actually be doing what they're saying is more adventure dining and taking it to new heights. I call it the Instagrammable moments. We're still going to be social distanced in some of our dining experiences, but when we're going to spend money, we want to have something really neat, something we can Instagram to our friends and show these beautiful meals that we're taking advantage of. And so restaurateurs around the world have been capitalizing on this trend. For example, in Budapest, there's this 4-star Michelin restaurant that's taking dining heights to new levels by putting it in a Ferris wheel, and you have a full course meal, and then hopefully with your group of people that you're in the same bubble with, and you go around and see that. So expect to see more of this adventure dining going forward. And also, I'm feeling very bullish about the massive pent-up demand of disposable household savings that we've had. We haven't gone to work. We haven't spent money on clothing. We haven't spent money on gas going to work, or we haven't been traveling as much. And in fact, this study is showing that in Canada, we're ranking third in terms of disposable income. In fact, 16.6% of now our disposable income is this excess cash. And they're calling it dry powder, which will just ignite retail spending. It's not all going into retail. Of course, some of it's going to travel into other areas, but expect this to be a huge boost to our industry. And the third prediction here is that brands will be getting the secondhand business, and we're watching this very closely. We're seeing a huge upsurge in secondhand. A lot of it has to do with the trending that we want to be closer to from an environmental point of view. And this trend is really, we're seeing it in the luxury goods. It's not the army surpluses that we've been used to in the past. So luxury brands such as Gucci has actually announced a consignment partnership with a company called Real in October. And why do they do it? Well, it helps police knockoffs, and it helps to support the value of their brand. And the resale market grew 25 times faster than the overall market. And so I think this is a real growth area to watch in the next while. And last but not least, one of the predictions is long live the drive-through in a post-pandemic world. Of course, this whole idea of safety is becoming more paramount to us than ever before. And we've been dealing with the Starbucks, and I mentioned Starbucks that they gave up 300 locations, most of them urban. They actually have a very high growth strategy in the suburban markets and specifically drive-through. Their drive-through business increased by 70% during the pandemic. And so they're just, really trying to blanket that market. Burger King, we're doing some work with them in Alberta right now. And the same thing, they say, show me a drive-through. If it's double drive-through, I'll like it twice as much. I just chatted with McDonald's the other day, and same strategy. So you're seeing, listen, if you're a retailer looking for those drive-through opportunities, expect to be paying a premium for it. As a landlord, expect a premium from that because I don't think this is going to go away too quickly. And Michael, that's my very brief, quick summary of what's happening in the marketplace, and hopefully that set the stage in terms of our discussion.
No, listen, that was fantastic, and I have to say, particularly for those who've been with us for many of our sessions for many months, you picked up on many of the same themes we've been talking about. I've been talking about, all of us have been talking about the stockpile, as I call it, this stored dry powder of cash, this disposable income. I got a lot of questions for you. So many great themes. I wanted to start with this kind of idea, and let's start on the retail side, so the front-facing side, and then we'll get to the industrial side. I got a couple of questions for you on there. Listen, the COVID era created winners, as you said, and it also created consolidation. Some, when I look at that Starbucks number, that decision was made very early on, and it wasn't made out of financial peril. It was made out of strategy. Others had to make different moves. When we sit back and we look at the overall landscape, is there a format, probably more than a location, but is there a format that will do really well in the coming days? The big outdoor malls were doing well during COVID. Is downtown going to do well? Main Street, the bigger malls. Any thoughts on, now that there's all this newfound leasable space? Where will the landlords be successful in filling that? You talked about a flight to quality, basically, and where will they perhaps struggle?
First off, I don't think grocery-anchored retail and the owners of those felt that they had much impact from the pandemic. I mean, from the fact that it's groceries, it's drugs, and it's booze, right? And so from a service perspective, we're going in there, and a lot of the retailers that we work with, and if they're doing renewals on that, sometimes they're many times we're actually seeing an increase in price. And the grocery anchor makes sense because the average consumer goes to their grocery store 2.1 times a week. So there's a lot of turnover, there's a lot of foot traffic. And so I think they will continue they've done well, and they will continue to do well. Yes, there's a big urban-suburban issue there. The downtown core of Toronto, 500,000 people aren't there. When the office buildings, unfortunately, are 5 to 20% occupied, it's just like a dead zone down there. And I have a lot of sympathy for retailers that have had their livelihood in those particular markets. I do believe, and I know confidently that I know a lot of discussions we're having from an office market perspective, there's going to be a real push to get people back by September, sort of a first tranche, and the second tranche probably after Christmas time. And of course, everybody being double vax. So I see a huge bounce back in that particular sector as well happening. I think the markets that have probably been most affected are those enclosed shopping malls in the secondary markets, the smaller communities. They've had a tougher go. E-commerce has really filled a lot of the void that people can get stuff now online. Retailers, when they've been culling out underperforming stores, have unfortunately probably been in some of those particular secondary malls. You mentioned a flight to quality. Yes, people are saying I'd rather have less locations, but I want to be in the best malls, the Yorkdales and the Chinooks and all that stuff, the Pacific Centers. And they're giving up, unfortunately, some of these secondary malls. And so I think they will come back, but they'll be slower. Some of them will go through mixed-use developments. I think we'll see an intensification and densification of these sites. And so opportunities for pads for retailers to go in there, or again, mixed use into residential conversions. That's a big thing happening now, especially on the rental side, especially if they're transit-oriented sites. Huge push on there. Not as much on an office side, but senior residence seems to be a big component happening there. Right-sizing the retail and adding storage. We're seeing a lot of storage. We seem to have bought a lot in the past. When we're downsizing, we're not getting rid of stuff. So we need some place to store it. So we're seeing a lot of storage in that areas. So I think those will be the areas. Look at the outdoor power centers. When we've tracked, mobile data, and we've looked at from enclosed to open air centers, they're tracking 10 to 20% more pedestrian counts in the open centers. And so that's been a real savior for those. And that's a safety thing. People just have that, I don't want to go in an enclosed mall. And so it's really had a dampening effect, unfortunately, for those enclosed centers for now.
One of the things I picked up on in your presentation is malls trying to innovate to be part of this broader e-commerce infrastructure, right? With BOPIS and at Yorkdale, for example, here locally, you can go in the parking lot and get your curbside delivery. Are you seeing much innovation? Let me ask you the question, is that in your mind, as you look at the landlords and what they're doing, an accommodation or a reaction to the current circumstances? Or do you think there's some intent there to make that an ongoing point of innovation so that they can really get involved with the transactions that are happening online and be part of this, returns even, right? Returns are huge and equally more important, and they've got great real estate and are very convenient. Are you seeing any innovation either here or around the world in that space?
Yeah, well, first of all, returns. I mean, we're getting a lot of inquiries from like a company called Happy Returns, wanting to open up there and those returns. Back to the curbside pickup. I mean, I think it was just eventually happening as consumers now. We've had to do it. As I say, it's increased by 100%. And so I think it's here to stay. It'll probably decline a bit. But we're also seeing is people adding ideas of impulse buying. Okay, you've ordered online, you pick up in store or pick up in mall. But what happens if you've forgotten certain items? And so I've seen some technology dropped in there to say, how can you, when you're having stuff loaded into your car, how do you get those impulse buying? How do you get those extra purchases there? Because I think that you'll see that going forward. I think there's going to be a huge shift in technology in both from retailers and from a shopping mall. And I think technology to have, when I drive to the mall, how can I pre-designate a parking spot? And when I go in there, how can I make sure that when I go to the retailer, they'll just meet me on a one-to-one basis. And so you queue up times there, right? And can I pre-order food before I go to the restaurant so I minimize my time there? And then when I leave, I get a free coupon about coming back. So the whole idea of that technology and consumers are totally into it, right? And so I think the malls and both the retailers and the malls need to uptick the amount of technology they're using. And it also comes down to cost savings, right? Using mobile data to see how often a washroom is being used. So you may have to clean it less frequently, or if it's being used more than you think, more frequently, right? Changing escalator directions to encourage different flows. And we're really seeing that in terms of how you use mobile data and technology to help in those particular areas. So I think that'll be the real push going forward in those particular areas.
Jump in on top of Michael here just for a second.
Sure.
Just going back to your point about impending return to work in sort of, office buildings, urban cores, those sorts of locations. I guess one of the questions I have is whether you're factoring in a partial return to work in the sense of, a hybridized version of you work a couple of days at home, you work a couple of days in the office, because obviously as far as traffic, that's going to be, relevant, even if there is some partial return to work. And I just wonder whether that is something that's sort of factoring into your thinking.
Yeah, well, Cushman's done a lot of studies on this in terms of back to work. And actually one example we use is Australia, because Australia didn't get as affected by the pandemic. And as you know, they had a very quick lockdown. And so some of our ideas of what numbers will be coming back are sort of based on that. And summers are winters. So they had a lot of people come back in their traditional, right after Christmas time, which is like our Labor Day. And then they saw the next wave happening around Easter. And so, and And there's no question that, we're going to have some sort of hybrid, but we believe that, first of all, probably 5% of workers over time will always be at home. But there's that 10% that'll probably be that hybrid model. And you're right, I think we'll first come back and we'll probably be 2 or 3 days a week. But I think if you want a career in any business, you need to be there. And if half the people are on Zoom calls and half the people are physically there, you'll lose the people on Zoom calls. Because we lose a lot doing what we're doing now. Being physically together has a different connection. And I think people will realize the importance of that going forward. So again, utilizing some of this information and what's been happening in other markets and moving it forward. Another interesting thing we saw in the Australian market is that public transportation didn't increase very much where people got into their cars. And it scares me when I go back to work because I have a big enough commute anyway. But I think it's going to be even worse because we're going to have it for a time. We're going to be fearful in terms of getting into the go, on the go or public transportation. And it certainly was clearly marked in Australia that has happened. And we're seeing it, this sort of telltale signs of that in the United States, that public transportation is still way below pre-pandemic levels. And so that's going to have an impact as well.
It'll be interesting as people get back to work and they're maybe jonesing to get back to the office, that they'll remember pretty quickly what an ugly commute can look like, exasperated by the fact there are less people on public transit, right? The last couple of questions just on the retail side, then I want to get to wholesale. When you think about, as you survey the landscape, we've talked about work from home as a big thing. We've talked about e-commerce. Both affect where you're going to be and how you're going to be as a retailer. What's your advice? Is one of the key constraints for retailers has always been trying to find great real estate. There's been a bit of a shakeout. Is now a good time to kind of lock in longer term deals or longer term relationships because there's real estate that's now on the market that hadn't been before? Is this a really important inflection point in your mind?
Some of the deep is percentage rent only for first 2 years, and then going back to face rates. We're seeing a lot more free rent than we've ever seen before. We're seeing the landlords are putting up more TIs because, again, retailers, you spent a lot of money, your capital reserves on surviving. And so landlords that we're talking to are recommending, but they realize they need to put more TIs out there. So it's an opportunity to look at getting a little more cash to outfit your stores. I'd be looking at that. I think opportunities now, foreign retailers that for Canada has always been pretty popular. And we used to see 35 to 50 new retailers coming into the Canadian market. And there's definitely a pause. And I think last year there was only like 6 foreign retailers coming in. And I think if you're a Canadian retailer, even foreign owned, but a Canadian retailer always in the market and looking for opportunities, I would say, and as I mentioned, it's all going to be about quality of locations, not quantity of locations. So when when they do come up, especially on street levels, you're going to have a little less competition, especially in the high street, a little less competition because when these foreign owners come in, landlords tend to like the shiny penny, rightly or wrongly, but they like the new shiny penny that comes in there and they tend to go after those retailers. We are talking to a number of them, certainly trying to encourage them to come. But most of them are seeing the bounce back strong in their own markets, whether that's Europe or the United States, and they're worrying about their expansion there before coming to Canada. But I suspect that we'll see an uptick probably in the latter part of next year or into 2020. So again, if there's an opportunity to jump on, that situation before these foreign retailers come in there, especially in the choice locations, I would definitely be looking at. I was also going to say, if you're looking at those secondary markets and those shopping malls, first of all, COVID has changed a lot of the customers and consumers. And some consumers have really benefited financially, have really benefited from the pandemic, and some have been very negatively impacted. And on the social level, some have been, with isolation, there's a lot more problems. And so you're seeing this change in consumer. We've actually done for a lot of shopping centers, we've seen these change in consumer behaviors of certain groups. And that may have changed if you didn't look at them all before. With this changing consumers, you may want to consider it. And if it happens to fall in these secondary shopping malls, why not set up a location there on maybe a percentage rent only deal, take a shorter term so you have less lease risk on there, and go in there and see if that's an opportunity to look at building up a new customer base, getting in a more effective number, and see if you can kind of grow your portfolio that way. Other things I'd be looking at is, driving percentage rent as much as you can. Looking at break options. If a landlord's a little more flexible, depending on the location, you can do a 5 or 10 year deal, but the right to terminate after a certain period. And Starbucks is classic for that, as you may know. And so I think landlords, if they're a little more receptive, they may do that. And I think it's an opportune time to say, okay, if I'm going to go into this location, maybe you could do a fixed rent for renewal terms. Landlords never do that. But again, if they're a little more anxious to get you into that and you're the right brand for them, you may have an opportunity to sort of control your costs over a long period. These are things that I would definitely be looking at, exploring new markets. But, a lot of the retailers, like especially restaurants, we're trying to look at them for new locations. They're saying, let's just get ready to get our existing locations up and running, and then we'll go forward for new locations. I think when your kitchen's burning, you're not mowing your lawn, right? You gotta deal with that immediate situation. So we're sensing more of that, but it will be back to more normality by year end.
Including a pretty marked labor challenge in that part of the business as well.
Yeah, we're hearing a lot of that. And I think technology will help in that. I mean, McDonald's, for example, is testing out a staffless, autonomous drive-through in Chicago. And, again, to reduce their costs, their staffing costs, and working late, it can be dangerous as well. And I think that'll help in terms of it, but it's a challenge. I'm on the ICSE Foundation board, and we're still throwing arm to help young people get into the retail industry, whether that's from a landlord's or retailer side. We're providing scholarships and internships because we believe there's a great future. It just has to be sold to people coming into this industry, that it's not a dead-end job. That's the perception, that there's a great opportunity, whether you're from a retailer side or from a landlord side. So we're raising $2.5 million to help that side of the business.
Last question for you. You've been very generous with your time. Thank you. I just wanted to just touch briefly on the industrial side. With so much acceleration in e-commerce, I'm sure that it's good days to own a warehouse as a landlord, particularly one that's well-centered. I'm seeing all kinds of warehouse proposals in places that are optimal and kind of suboptimal. I imagine it's going to be a very active part of the landscape, the real estate landscape for, perhaps the next decade. And, even when they start doing double decker, I've seen them in the States, they're starting to build 2 or 3 level warehouses where you can have your own level. What are you seeing in that side of the business, just as a kind of final thoughts?
Well, the darling has been industrial and land sales, whether it's residential or ICI land. I mean, they are on fire as it relates to sales and for leasing. And I agree, 1 out of 5 deals is e-commerce related. And so we're seeing that's just had a huge push on the industry. First quarter of 2021, the stats across the country for industrial vacancy was 2.2%. Toronto, it's only 1.5%. Toronto is an 800 million square foot market. It's the 4th largest in North America, and with only a 1.5% vacancy. I think people have woken up to find that, it's a great business. A lot of businesses are operating from a lot of industrial because, again, from the e-commerce perspective, we have seen rates skyrocket. In fact, nationally, for the first time, we've seen double digits. I think the average was $10.22 for industrial space. And so you've just seen this huge ramp up in rates, and you've seen a huge decline in vacancies. And so, yes, I think it's here to come. There's a lot of speculation being a spec building in industrial, many without a tenant in place, which was very unusual. But most, by the time they've been finished, are finding the industrial users. I mean, Amazon's been a great occupier of some of these locations.
Catalyst,
So yeah, I think you'll see a lot of that. Now you're talking about these multi-level warehouses. There's some discussion. There's actually one in Vancouver, and there's been discussion on it. But there's a lot of logistic issues you have to deal with it. Floor loading. When you've got a 53-footer and you got to get it up a ramp and coming around, and so there's a lot of turning radius required especially just on the ground floor, let alone a second level. So that's really impeded a lot of these second level developments. What we're seeing more is heights are going up. And, look at the Canadian Tire distribution and the 407, right? past the 427. I mean, that's a 60-foot clear, robotic, type of stuff. And so instead of going double decker, you might as well just go higher. I mean, the traditional, you wouldn't build less than 32 today, but some are look at going higher and higher. Not to say if rates go stupidly high, above $10 or $12 to $20 or $25, and land is really expensive now. I mean, to find a corner property, if those retailers are looking for beautiful corner sites, I mean, $3 to $5 million is not unusual. So they're getting really expensive. And so industrial land is no different. And so, but expect to see that. I mean, our biggest fallout this year, and this is not true just for Cushman, but for all our industries, is office leasing is down quite a lot. And the reason is no one knows what to do. Carl, back to your, I don't know if I'm going back or I'm going back. And so all the banks and the financial institutions, and they're just sitting on their hands right now in terms of determining what to do.
Well,
when
from
to
what I'm hearing from my classmates, the law firms are leading the charge here to get everybody back in harness. But I don't know whether that'll spill out to financial services and tech and so forth. We'll see.
Yeah, well, Spotify. We do the work for Spotify, and they've announced that they're going to have an at-home program, but they've taken on more square footage. So, what they say. One thing we did see in the pandemic back to office space, it was a huge uptick in sublets, and that's actually curbed down where people have pulled that space off the market. And that's been the latest story. Is that they do need it back, and I think it's dangerous if you're a major bank and you gave up 200,000 square feet, and 2 years from now, we're back to a normal, whatever that is, but everybody's back in the office and you gave up that square footage at 50
cents. They were all building sub-offices for the longest time. So it would be interesting. I think they might shrink back on their core properties.
I was just going to say the last thing on industrial, and what's with the other phenomena that's happening is that I used to manage industrial, and for years, what's the rate of industrial? Oh, it's 575. Well, it'll be in 5 years, 575. What was it 10 years ago? 575, right? And so what was happening is that the retail users were doing very short-term deals. In fact, our average industrial deal was only 3.5 years. And because of this increase in rental rates, the shortage of low vacancies is where people are locking in for 10 years. And that's a huge change in the industrial side that we had not seen literally for 20 plus years. And so I think that'll change the dynamics of how space is managed, and how industrial tenants are going to have to look at their business differently going forward.
Well, John, this has been such a great overview. I mean, it's exactly what the members have been asking for. So I wanted to there's not any, I'm just checking just to give the members a chance to ask any questions. I see a couple of questions, but not related directly to real estate. I think your presentation's been so comprehensive, it answered a lot of questions. I guess the last question is, how could people get in touch with you if they need to learn more or maybe want to reach out? What's the best way to get in touch with you? Is LinkedIn a great option?
LinkedIn's a great option. So please go onto that site, and happy to answer any questions you have. Happy to give a copy of the presentation if that's of use. So let me know on that.
That'd be great.
But you can go on the Wakefield site, and my contact information is there too.
Thank you so much for joining us. And we'll hopefully see each other in person soon. We'll continue the conversation. So much more to chat about. Such interesting days. So once again, thanks for joining us here on the live stream, and have a wonderful, I hope you take some time off and have a wonderful evening and days ahead. Thanks for tuning in to today's episode of The Voice of Retail. Be sure and follow the podcast on Apple, Spotify, or wherever you enjoy podcasts so you don't miss out on the latest episodes, industry news, and insights. If you enjoyed this episode, please consider leaving a rating review, as it really helps us grow so that we continue to get amazing guests onto the show. I'm your host, Michael LeBlanc, president of Emmy LeBlanc Company, Inc., and if you're looking for more content or want to chat, follow me on LinkedIn or visit my website at emmyleblanc.co. Until next time, stay safe, have a great week.